Okay, Sean.
Stefan, nice to meet you today. My company is Apex Real Estate Investments. We're in the Northern California flip market. We're doing 2 to 3 flips every week. We are looking to now do a residential buy-hold model. The United States residential market has just tanked. You can purchase properties for less than replacement cost. At the current time, we're active in 3 courthouses, and we are able to purchase cash flowing single family residential properties at about 20% below fair market value. So we have a inherent discount in the purchase. The rental market is very strong, and we are able to cash flow $300 to $400 per month per asset. And we are looking for a all cash investor to back the fund. We can put about $40 million into 5 markets over the course of about 18 months. And we have a very senior board of directors that's backing the project.
Okay, so you have collected $40 million to go into this new fund?
We would like to raise $40 million per market for five markets, correct.
So you're raising this from private investors?
No, we're going to institutional investors.
And you will use that 40 million then as equity?
No, that's
you're looking for us to provide you with the finance, of which the 40 million are the equity.
The 40
or are you
million.
Pitching to me are you pitching for me to invest in your fund, or are you pitching to me to provide the finance for the properties you will buy and hold?
That's correct. To provide the finance for the properties that we'll buy and hold.
At the time you bring the first deal to us, you will have 40 million in cash in your account?
No.
No?
We're looking for 40 million per market in 5 markets. 40 million is unlevered.
Yes, understood.
And we're looking for a group that sees and understands the business plan and knows that we're not going to be buying any properties that are not currently cash flowing.
Okay, and how much leverage are you looking for?
Well, we're not looking for leverage, but if we do a leverage play, we need about 5 million per market.
Okay.
Or you can put up the 20% equity, and then we'll raise the debt once we buy the assets. We can cash out that.
So you have a second alternative for me?
Yes, we do.
Okay.
We've
Can you
raised.
just run by me again the 2 alternatives?
So
From my perspective.
Yep, we have a debt partner in Los Angeles who will do the cash out refinance post acquisition, and they'll come in at 80% loan to value, but they don't want to put anything less than about 5 to 10 million out at a time. Hence, we need an equity partner that can come in on the front end and help us get these blocks or these pools of properties financed, and then we can come in with the partner in Los Angeles, and we can do an 80% takeout, which would put 80% of the cash back into your bank.
Okay, so in order for them to finance 5 million, you said that's a minimum tranche.
Mm-hmm.
They're providing 80%, so you need somebody else who brings the first 1 million.
Correct.
Okay, and what is your current liquidity in your current company?
About $1 million.
Okay, so you, with your own equity, you could invest 1 million. You have a partner already lined up to finance the 80%. Then they would give you the 5 million.
We're looking for the 5 million. Correct.
Okay. So far you have flipped the properties 2 to 3 a week, you said. So how long was your holding period?
The holding period average is 65 days.
65 days. And now in future you are intending to buy and hold. What is your future holding period?
We want to run the 2 strategies simultaneously, and we are looking to go nationwide with this platform because you can buy discounted properties in very strong rental markets all across the United States, but we want to get started in a local market so that we can pilot the model and attract cheaper capital. So our long-term goal is to have $500 million or $1 billion under management, but currently we're just looking to run the strategy in our backyard.
I understand, but you're talking about volume and geography, whereas my question was about your future holding period.
5 years, sorry.
5 years, okay. Okay, is there any... have you had experience how to manage properties for a longer period? Because obviously in 65 days, all you do is you buy and you market in order to sell.
Correct.
Do you have any experience in property management?
We actually have a partner who's one of the top property managers in Northern California, who we're going to bring in on a fixed cost basis to handle all of our lease ups.
And the fixed cost, is that per unit or a fixed annual fee? How do you compensate?
A fixed annual fee of 3% of total rents.
And they're going to also do the new rentals for you?
Correct.
And what's their incentive for that?
It's a portfolio, so they're able to bring in a ton of business with one client.
But are they being incentivized if you have empty vacant units to rent them out, or is 3% of the net rent, which is basically covering their cost of starting, the only incentive, or do they get 3 months rent if they rent something out which is so far vacant? What?
They get a sign-on bonus, so they take half of the first month's rent. So the quicker they get that place rented, the quicker they get the sign-on bonus, which is half of first month, which is about probably $600 to $700, $800.
Okay. You were talking about your cost price and replacement cost. What is, if you take a standard 3-bedroom family home, detached, what is the current replacement cost for that, and what is your cost price?
Currently, we're at about 50% of replacement cost. So land as well as construction costs to build a home in the Northern California market that we operate in would run you around $200,000 to $300,000 right now.
$200,000 to $300,000 is the replacement cost, and so you will purchase it at
$120,000 to $150,000.
And what's the difference in the rental income in a new unit and your current unit?
Probably only several $100 because most of the units that we're buying are under 30 years old.
Okay, and in real figures, if you give me a standard rental income for a new unit and a rental income for one of your second-hand units?
New unit would be around $1,900 to $2,000. One of our units per month. One of our units would be probably the 14 to 16 range per month. So at 18, our real plan is if we have an 18-month buy cycle at 3 a week, which represents one market, and we take a 20% discount on the asset to fair market value, and we times the annual capital appreciation on the portfolio by 5 to 6% per year, which is very conservative. Our market's gone up about 15% in the last 12 months because the home values in this area are much lower than they are in the Silicon Valley, where everybody's going into foreclosure at $800,000 to $900,000 homes. So they're able to move to Contra Costa, East Bay, in Northern California, and pick up the same house for 1/3 of what they could live for. So their cost of living goes down dramatically, and that's the driving force behind our market. That's why sales are good. That's why the rental markets are strong. And at 3,
you're talking about sales, but you're actually not intending to sell any of these properties.
Well, no, this supports our rental market.
Okay. And so you mainly hope for tenants who are relocating from Silicon Valley to your area.
Correct.
And these are mainly people who lost their jobs in Silicon Valley, or?
No, they haven't lost their jobs. They've gone into foreclosure on their current home, or the cost of living is too high.
So they've gone themselves into foreclosure. So your new tenants, the majority of your new tenants will be people who have been foreclosed in their old homes. So they will probably have a lot of debt and a bad credit record and so on.
Not the majority, but definitely a good percentage. Probably 20% of our renters will have some type of credit issue.
And sorry for my ignorance, I should know that as a local banker, but what's the distance between Silicon Valley and your location?
45 minutes to an hour.
Okay, so people will commute in future to Silicon Valley from where you are, or they will settle in a new community entirely?
No, they'll still do the commute every day, which is not uncommon for where we live, because Google, Yahoo, eBay, Sun Microsystems, all of the major technology groups are in Silicon Valley, and most of the people are commuting either from San Francisco or the East Bay, as it is anyway.
Okay. Which interest payments can your cash flow support for the bank?
We're underwriting these properties about between an 8 and a 12 cap. So we'd like it if the debt was somewhere around 7 to 8. That'll give us some arbitrage play, which you guys can take a first lien on. And we'd also like to offer the bank a security pledge on the LLC to hedge against any capital losses.
Okay, so from our point of view, we would take pledge of the shares of your entity.
Correct.
And you will have all the assets in one entity?
Correct.
So you will not put up a new entity for each 5 million badge? No. Okay. And we have mortgages against all the properties?
First lien position, correct.
Yeah. Assignment of rental income?
Assignment of rental income?
Guarantee of directors?
No.
No? Why? You don't have any confidence in your business?
No, we absolutely do. We just have other options, and right now we don't need to go full recourse. Okay,
so if you're not going full recourse, what is an amount you would feel comfortable to support?
We'd
like
be
a guarantee for a limited amount or whatever.
We can talk about that, but right now we have 3 other banks that we have term sheets from who are very supportive of this deal.
Are you happy to share that term sheet with me?
Yes.
Okay, have a read it.
These have been redacted here, so you don't see the names of the banks that we're working with. But
that's all right. All I do is recognize the layout. Okay, that's fine. So we could get a deal if we match these terms?
Yes, sir.
Okay, why is that? Why if we're matching these?
Well,
what is the uncertainty in this term sheet or the conditions precedent you still have agreed? If you say, look, if I match these terms, I could definitely get a deal. Well,
these guys over here can only do 40 million in 2 markets, and we need to fill the capitalization stack for the remaining 3.
Okay. Okay, so when do you think you can bring the first sample properties to our attention?
We have a current portfolio where we can show you samples and financials. If you want to take a look at some sample deals, but what we'd like to do is start with the first 4 million in the account, and we could spend about 450 of that a week in one market.
Okay, so if I go back, you said you currently have 1 million in cash in your account.
Correct.
You're happy to transfer that 1 million to us. We basically provide 4 million, so you have a hunting facility of 5 million, which you can prove to the prospective sellers of the property, or which you can prove to court if you're in a foreclosure. So basically, from your 1 million, we make it 5 million.
We're not actually looking for a co-invest. We're looking for you guys to put up 100% of the finance in the beginning. Our LA partner will cash you out 80% loan to value, and since we're buying these at about a 20% discount, that takes out your entire capital position. So that is our equity.
But you want us to take 100% of the risk to start with?
Correct, because it is a cash flow positive model with a 20% discount to fair market value. So the bank's position is hedged against any loss. Okay, but at the beginning of the deal you said you can bring 1 million to the table. I mean, which is not a lot, talking the size we're talking about in the context of your ambitious plan. Okay, we'll put the million in.
You put it in, okay, good. That sounds much better. Okay, so that's fine. There's only really two questions left. The first thing is, you said you have somebody who provides you with 80% loan to value.
Correct.
And you say you're purchasing at a maximum of 80% loan to value.
Correct.
So your entire business model depends upon this one other funder in San Francisco, which provides you with 80% loan to value.
Los Angeles.
Los Angeles, sorry. And what if they turn around and say, look, we sent round the valuers, and they come up with the same value you bought at? Or if they come up and say, look, you paid 200,000 for this, we give you 160. So if they are 80%, which is quite high in the current market to provide me with 80% funding, but they will say it's 80% to purchase price rather than 80% to value from 2 years ago.
Well, since there's a 20% equity piece in the capital stack, wait, I just drew a blank. Can you ask that question again? Sorry.
Okay. The whole model seems to, I mean, what we're doing is we're basically providing the bridging finance because you have somebody who funds 80% of loan to value.
Correct.
And 80% of loan to value, you say that the problem you have is that they only want to roll out in 5 and 10 million batches.
That's correct.
They don't want to deal with each specific house.
That's correct.
But once you have a portfolio of 5 million value, they will lend you 4 million.
That's correct.
Yeah? So, my whole axis
against the loan to value in the property. So it's a function of the value on the home, which means that your position can be refinanced at 100% because we have the inherent discount at the time of purchase.
Okay, so basically, and this is a firm commitment of the lender in Los Angeles.
We have term sheets, yes.
You have term sheets similar to this term sheets of our competitors for our role. You have a term sheet for that.
Yes.
Because, and we're happy to support you, but I think it would be good for both of us to work together when you negotiate with the lender in Los Angeles, because it seems like your whole business model, and in the end our risk, will entirely depend on whether the lender in Los Angeles will accept the valuation, so we come to the same value of the property. Because if the lender in Los Angeles quite understandably turns around and says, look, the value in the current market is determined by the market forces, and therefore the value is what you bought it for, well then we're 20% short.
That's correct. We have a long track record of doing these deals. We've done over 100 on the flip model, and we have a portfolio of roughly 5 million on the buy hold. So we can show pro forma numbers. And the bank in LA has approved our appraiser.
And you still continue the flip model at this moment in time, or you simply switch to a buy and hold strategy now because it's difficult to flip homes quickly in the current market?
Actually, it's not difficult, and we're maintaining the buy flip model because it generates cash flow, and all the guys down at the courthouse are not going after the lower balance buy and hold assets, and that's why we've seen this opportunity in the market, because none of the guys that we compete with want to put that kind of money at risk for 2 months just to make $10,000 or $15,000 on one home, and that's why there's this incredible buy hold opportunity.
But yet you're asking us to put our capital at risk for the period between you purchasing and being refinanced by the Los Angeles institution.
Well, it's not at risk. The reason why these guys aren't putting their money up is because they can put up 200 to 250 and make a quick $50,000 or $70,000 pop on a larger deal versus putting in less money on a smaller deal. But the risk profile for both are the same.
Okay. And how much of your time and of your fellow directors' time will you put into the buy and hold fund? Is it 100% commitment of your time, or?
Our business is already set up with the foreclosure courts, and so we're actually down there 100% of the time anyway. So there's actually no extra work being performed on our part to acquire these homes and to portfolio them.
Well, what I'm really asking for is you say you will continue the flip model on one hand, and you will in parallel set up a buy and hold model.
Correct.
So what I'm asking for is, you have not so far financed your flip model. What, of your commitment, of the real expertise in the company, should be flattered by now, how much are you going to devote to the new venture?
The new venture is my responsibility and my board's responsibility 100%, while the existing team for the buy flip are going to stay.
So you will not have a say in the buy and flip part of it anymore?
No, I'm heading up the buy hold.
Okay. So how do you manage but you have the same shareholders in both, or?
This is actually a new fund,
Yeah.
and there are two managing principals, myself and my partner.
Okay. And you and your partner will take the decision?
Correct.
And who will take the decision in the flip model?
He is actually making the decisions on that business.
And you take it together with him in yours. So how do you manage the conflict of interest? Because what I have to explain to my colleagues is you're buying a great deal, you got it down at the courthouse. At the courthouse you still represent flip as well as buy and hold.
Correct.
What we don't want is that all the ones you can flip, you take the profit entirely, we do not participate. All the ones which may not have been such a good buy just come into the hold basket because you're not able to flip them. So how do you manage that conflict of interest? How is it transparent to me that the good deals will also go into the hold?
That's a very good question. And since you guys are providing debt and you're not providing equity on the deal, the backside of any transaction you're not actually participating in. So whether it was a buy hold model or a buy flip model, since you guys are putting up debt for this deal, it wouldn't matter if we were making more money or less money at the time of sale. So
well, what happens to me is the value of my collateral, and I could understand and share your attitude if we were not providing any risk capital. If we are simply providing 40-50% loan to value, then I may not care whether you intend to flip it or you intend to hold it. However, if we provide you with as close to 100% finance as possible, then I can't say all your good buys, all your good properties, you're going to flip and keep the profit. All the bad ones you are holding, because that's the value of my collateral and that's the value of my cash flow. So I think there needs to be a clear understanding between us how you manage the conflict between the two models and how we make sure that if a certain property comes up, you take a decision in advance. This is a property you want to send to us. We approve it for the buy and hold, but once it's approved for the buy and hold, it stays in the buy and hold until such time that it's refinanced by the Los Angeles institution. Or if you want to take it out at that moment in time when we are being repaid, that's fine, but you can't take it out before we're being repaid for that tranche.
what we could do is form one single entity that we run all the properties through, and that all the properties go into, and anything that's flipped out, we take the upside, and anything that remains in the fund stays financed.
Yeah, if everything is in one entity, that's fine, and we pay the cash flow of the flipping into the same entity, and it gets released to you at the moment of refinance. So that's fine, and then we got a deal.
Correct. Deal.
Two things. The inherent risk in the $250,000 deal as opposed to the $15,000 is not the same as what Sean said. It isn't the same. The risk is less because you're doing less transactions for more money. So it's not the same risk. The guys that are staying on the flip model for $250,000, you got to come up with a better answer than that, Sean. And the guys that are doing the smaller deals, the reason the guys that are keeping the big deal, which I'm very familiar with this model, as Sean knows, is that because it's easier to make more money faster in bigger chunks with less labor, less aggravation. And I also know the more houses you get involved, the more aggravation. And if it was an experienced property broker or banker, he would know less deals at bigger chunks is better than more deals at smaller chunks, just for the management. Forget about the risk. The second thing is, Sean said, well, our real deal is this. That means everything that he said before the real deal was all a fucking lie. You've been taking lessons from Bjorn and you don't even know him. I mean, the real deal. And so that means, and if I got involved and I would have pressed him, then the real deal would have come out. There would have been a third deal. You don't say the real deal. This is the real deal from the beginning. You don't change. You don't change your verb or your adjectives that you use to describe. Otherwise, the guy's going to lose confidence. And he may describe this model as being riskless, but it's not riskless. That's bullshit. It's absolutely not riskless. And there's really not enough margin. 80% loan to value, that's a good, in this market, that's good loan to value, 80%. But when you're doing this for 10 or 20 grand a pop, not every house is going to get done. And the 10 or 20 grand per pop sometimes will wind up being no grand per pop, or lose 5 grand per pop. And the reason why I've gotten out of this business model myself, and I used to be in the same thing with Ronald Rand and Damien Lupo and 4 or 5 other guys over the last 10 or 15 years, is because even though they seem to be managing it coherently now, the bigger you get, the harder it is to manage. And and it is, as you pointed out, Stephen, it's a full-time job. And there is a conflict between the two models. I'm not even sure putting it into one pool solves that.
No, I mean, basically for me, it was at this moment in time simply, he said I could get all the profits from his other model into the pool to be security for me until I've received.
I'm not sure his other partner would agree to that.
Well, I don't think he would, but that was
I'm positive his other partner would agree to that.
He also committed to putting all his cash of 1 million into my bank account as additional security. So again, his partner may not agree to that, but once he agreed to all of that, and he starts with a small tranche and brings me, has given me 1 million in cash, assigned to me the shares in his company as a security, and basically everything he has said we can talk about a personal guarantee. That was still an open issue. I got everything. If he really follows up on it, that's fine.
So Stefan went around, he was nailing down the corners. And then once you nail down all the corners, there's not many places to escape. But I mean, but China, that was pretty good presentation. Whether his business partner would agree to some of those things is another question. But that's more realistic what one of these things should sound like. And flowed pretty well. It's fairly coherent. Sean's been hustling money for a while, so he's done this before. He didn't just fall off the car. What do you call those carts in Romania? You call them chariots. Chariot carts in fucking Bremerhaven. So it sounded different. Okay. Any questions before we break for lunch?
Yes, I have.
Oh fuck!
Well, you wanted to ask.
I want to do yes.
Okay, what is the mechanism that you use to, you said like you have 4 or 5 rounds of investment, and after that you wipe out the initial investors?
No, I don't have many deals. The majority of deals aren't successful in the first round. So if they come in the second round, the new investors, Bjorn looks at Michael put up €1 million, and Bjorn says, "Fuck, Michael, I don't care what he put up. The deal is worth this. So I'm going to wipe him either completely out or almost completely out. Before he had 70%, now he's got 20%. Okay?
How do you do that?
You just do it. It's just like my words to the contract. Your equity, instead of being worth 70 now, is worth 20. And my equity is worth 60, and your equity, and obviously your equity goes down. Everybody's equity goes down. Everybody that comes in and puts in new money almost always wipes everybody clean. They want to wipe the debt clean. They want to wipe the equity clean. And if they can't do that because there's too many creditors, then they just bankrupt the fucker and they buy the assets out. And then when they bankrupt the fucker, then everybody's clean anyway. Because we're not going through reorganization, we're going through liquidation. I don't like reorganizations because too many people who always you got to fight with liquidators and not with liquidators, but the insolvency lawyers and all this other bullshit. It's just easier just to wipe it clean by bankrupting it. But I mean, I'm telling you, anybody that comes in for the second, third round, I mean, this Four Seasons deal with John Moulton, to the best of my knowledge, it was the second and third round, but Moulton's Alchemy put all the money up. They put their own money up, so they weren't wiping anybody out. And I don't really know, but I would imagine I would be surprised if they hadn't been somebody else, because sometimes 3 private equity firms will put up the first round, but then the second round only 2 want to put up the money, so they wipe the one guy out, and so maybe in the third round only 1 will put up the money, so he wipes the other guy out.